invited Jena Lanini over here to do I want to preface this. This is a friendly debate, okay? I don't expect any, there might be some heat here, but I don't think there's going to be any animosity.
No.
So talk to Jena. Jena and I have known each other since high school, actually.
Yeah.
Yeah, or
Long time.
probably before that.
Probably at least middle school.
Yeah.
Yeah.
And so this, I don't even know how this started, right? We're here today talking about rates and home prices in the world and things like that. And so a little bit of an intro for Jena. She has a broker sales license with Coldwell. Also, big fan of Reps for Recovery.
Yes.
Which I'll definitely give that plug. So Reps for Recovery, really cool nonprofit here in town. I think you guys are spreading out other areas as well.
We have 6 classes a week. And actually that 7th day is filled too because we do climbing night.
Okay.
And we added that yoga class on Monday. So we have something going on every night of the week.
And so reps is for people seeking recovery or in recovery.
Yeah.
That want a cool place to lift out and have some camaraderie, right?
Yes. So we offer free workouts for people in recovery or supporters and allies, which is a huge thing because we're trying to reach more people in the community. And we've found that even those folks know somebody that struggles or has a family member, right? So yes, big thing is the working out aspect. It's CrossFit, but you can modify scale everything. And then we've added that yoga class, and we actually are going to be adding a class into Bristol Cone, which will be for their,
nice.
Those people that live there.
Do you know I'm on the board?
No, that's awesome.
Oh my God.
And so that's going to be really cool because we added 2 new coaches, and they have a gym, so it'll be more of just a functional fitness, normal fitness class. Cool. Yeah.
We'll have to touch base on that afterwards too. And then
she just joined the board.
Yeah. Oh, sweet.
For reps.
For reps?
Yeah.
Awesome. Cool.
Yeah.
Sweet.
Yes.
I don't think I was at the first reps, but I was there for the first couple of years.
For sure.
Where you been?
Repping other places, Dan.
Yeah.
Check them out.
Doing all sorts of other stuff. It happens.
Gone but not forgotten, right?
Yeah.
And then last minute we had Megan Wall join from Guild.
Yes.
And Cal Lewis from the Lewis Group, which is us.
We are going to kind of debate on what we think will happen to prices when or if rates go down.
Yeah.
We're all crossing our fingers rates will go down because this is kind of out of pocket right now. But Jena, what is your view on when rates go down, what do you think prices will do? And how fast do you think it'll happen?
So I don't necessarily think that the rates are what is dictating our market value at this point. So I don't think that when rates go down that prices are all of a sudden going to shoot up, because how far will they go down, and will that really release more inventory to the market? And right now, being that we're low inventory, things are still moving at a steady pace, right? We just talked about multiple offers in that 400 to 500 range, but it's, I don't think that there's enough people out there to say that like prices are going to shoot up and this competition is going to be crazy once rates go down to what? If they go down to 5%, that's still huge.
Oh yeah.
But it's not like during
doubt.
COVID, right?
Right.
Where it was like, that was insane. And I think that's what would allow the other people to release their homes, right? Because then they're like, well, if I can get rid of my 2.7 and get a 4, but I don't think we're going to see that.
Right.
So I don't know. I think that one of the biggest things, I don't think our value is going to continue to go up like skyrocket. But I do think it will continue to steadily go up like it has. And what I talked about in this video, which was insane, that went freaking crazy, was that 1 in 4 people think that the housing market's going to crash.
Right.
But that I don't foresee happening because we've still seen appreciation over the year, but it wasn't this skyrocketing, like this huge percentage, right?
Right.
But I love the concept of like the decelerating appreciation does not equal depreciation. So people were just like shocked when things started just going up like 1%.
Right.
2%.
Yeah. Well, yeah, because over the last 3 years we've gone up. I think the stat that I pulled was 35% since January of 2021.
Yeah.
Which, in my opinion, right, is not totally sustainable.
No.
So what we're seeing, I think, is healthier for the market.
Yes.
And one of the things, so I guess just a follow-up question to the rates question that Cal just posed is, what do you think what do you think about a recession coming next year?
Well, I think that that's probably inevitable. I think it should have happened.
Right.
And
Or we've been in one.
This
Right?
is,
We've
yeah,
already
and
been
this
in
is
one.
not like a political debate, right?
Yeah,
but
not
I
at all.
think that certain things happened. Should have happened a long time ago. But that can totally be debated, a whole other topic. But yes, I think that will happen, 100%. And I think that more people who have been waiting will get off the fence. But I don't think we're going to see this skyrocketing thing. I think Nevada's insulated.
So happy to hear you say that.
And Nevada is insulated.
Right.
And we have been. I don't think that the rest of the nation has had this beauty.
Yeah.
People are moving here. I deal with people all the time that are not from here. That has not stopped. It's been a very steady thing. I don't think it's going to go up, and I don't think it's, so I don't foresee this being all of a sudden rates go down to 5.5 maybe, and there's like all of a sudden again, like South Reno is 1 million plus.
Right.
I don't think that that's going to be the case.
Well, one of the last videos that you posted, you said I think you went to the Bowtie Economist.
No.
You didn't go see the Bowtie Economist? I thought you were in his
Oh,
class.
for the
Elliot,
CCI. Oh, yeah, yes.
Yeah, so and what you said was the next 6 months are going to be very telling.
Yes.
And I think that is so crucial and so important because we don't know what's going to happen.
Right.
Right? Like, do I think that rates could come down and prices could go up? For sure. There's possibility of that.
Yeah.
Is it more probable that over the long term we're going to see maybe a slight correction in prices, where I think we've already started to see that, because what we were just talking about was last month, right? Last month the stat that I saw was it was 30 or 35% of homeowners gave concessions nationwide. So effectively, right, we're not lowering our purchase price, but we're coming down in concessions, which is effectively lowering the purchase price.
Yeah.
On top of that, how long is that going to be an option for buyers? We already ran into it last week with an appraisal coming in low because we're trying to get the seller's bottom line to where the seller wants it.
Yeah.
But we also need to get these credits to the buyer. So we're going to see that gap close here pretty quick.
I think you've already seen it shift, right? Because where 6 months ago we were raising the purchase price and then asking for those concessions, now we're staying at the purchase price and asking for concessions.
Yes,
Right.
Totally.
Right? What's next? We're just going to ask, we're going to just not ask for concessions and start lowering.
Yeah,
prices.
which that's what I've got going on right now. No concessions.
Same.
Right? And I don't know, that whole game of, well, we've got all these showings this weekend, you might want to get rid of that concession, right? I don't know. And we can't determine how other agents act, and I think that's fine. But I don't know if it would have necessarily gone above asking price.
And it drives me crazy because I don't know how many times over the last month I've been in that situation where I have a buyer interested in a property, but then the listing agent or the seller doesn't want to review offers until 5 days later. Or, we've got 19 showings this week.
Yeah.
And there's never 19 showings. Like
You look
6.
at showing time,
right.
like every spot's available.
Right. We've got 6 showings this weekend, so we're going to want to wait for that. My theory to my sellers is always, if you've got an offer, let's talk about this offer right now. Let's not talk about stuff that hasn't happened yet. So, I mean, that's a whole nother video.
Yes.
But
Yeah,
that's been driving me
I
nuts.
think you have to play the market. I heard a great quote. You have to play the market as it is, not as you want it to be, or how you think it's going to be.
Right. Yeah.
And I'd love to talk to you because we were, one of the first things you said when you came to dinner, you asked me, when did you buy your house? Right?
Yeah.
I said 2019. You're like, oh, you're so pretty, right?
Yeah.
And so I think that's one of my fears going into this next year is are you guys familiar with the wealth effect?
To elaborate.
I'm not.
So the wealth effect, right? So it's really expounded when you talk about home values, right? And that's where we see it the most. So I buy a home, and then within 2 or 3 years, right, we'll take my house. I've got $300,000 in equity.
Yeah.
This is all public. You can go see this, right? I'm not saying anything that I'm worried about talking about, but so I have $300,000 in equity. So the average person, and there's a study done on this, the average person is like, I'm $300,000 wealthier.
Yeah. Yep.
Right? It's not realized gain yet. It's something that maybe I can pull equity on, or I just feel that way. And so my fear is, and I don't think we're going to crash either. I don't think we're going to see a GFC crash. Generally what we see over most of these recessions is we just see it slightly decline a little bit, but kind of just stabilize, which I think we need that stabilization because we need incomes to kind of catch up.
Yep.
But anyway, so then it takes me to the reverse wealth effect. So when you have this perceived wealth of 300K, so now I'm living like I'm 300K richer, right? My credit card bills are going a little bit higher. My vacations are going a little bit, I'm taking more and more vacations. So now, if we start to see that dip, and we start to see and feel some fear in the markets, whether it's through social media, mainstream media, whatever, that's where I could see a compounding effect ripple kind of through the market.
Yeah.
So all of a sudden, my home values decreased, so I'm having this reverse wealth effect. It's more something that we feel on a daily basis rather than, does that make sense?
Well, yeah, and it's the same concept of like if somebody sees a listing come on and it's listed at 500,000 and then 2 weeks later it goes down to 475, they're like, the market's crashing.
Exactly.
No, because there was perceived value in that home doesn't mean that the value was there.
Yeah.
And I think that's hard for people to understand because they saw South Reno as an example. During COVID, it was like everything was being overbid, 100 grand. Oh my God, South Reno. But it was maybe folks like you who had $300,000 of equity.
In 3 years.
That was like this wealth that where does it come from? And so that stabilization is where I think that fear of market crash is coming from, even though it was never there.
And it's a domino effect, right?
Yeah.
It took 4 years for this wealth effect to happen.
Yeah.
And then the reverse wealth effect almost feels like it's all at once.
Yeah.
And that's where we see kind of that domino effect come through the market, or we have in the past.
Yeah.
I just saw, speaking of the bow tie economist, Elliot Eisenberg, his email a couple nights ago, I think, was something to the effect of comparing underwater homeowners now versus like at its worst, right? And it was something like less than 1% of homeowners right now are underwater.
Yeah.
So like 0.7% or something like that nationwide. It's like 400,000 homeowners or something like that. Those might be the people that had the debt consolidation during COVID, and it's just now coming to fruition that they're going to lose this place or that they're still underwater somehow.
Yeah.
But that is coming from like the worst of the worst, where we were at like 30% home ownership or homeowners underwater, which is kind of crazy and kind of, it's so far off from where we were.
Yeah.
But if we do start to see people, buying the razor, buying the, going on vacations a lot longer, which kind of feels like where we're headed or kind of where we're going. I don't know, but we could start to see that number increase, which could lead to a crash. But I think we're smarter than that. I mean, I would like to think so.
I would agree. I think one of my, with that domino effect in mind, my only concern is that where these people might still have equity, right? We could see where you were saying then, rates come down a little bit and people want to start selling because they've been waiting to sell, right? And then there's this fear that, oh my gosh, prices could start going down, or they are going down because I'm seeing these price cuts. So then we see more and more houses come on the market, and the only reason rates come down usually, and we have history that tells us this, is because we're in a recession and the economy is not doing well, right? The Fed's mandate is price stability and sustained employment.
Yeah.
So so that means inflation's going down and unemployment's going up, right? They don't use those terms. They use these like special nice terms on, but it's inflation and unemployment.
Yeah.
And so if unemployment's going up, we don't have enough people, right? I mean, I've got some pretty crazy stats here, right? Consumer credit's up 38% since April 2021.
Yeah.
People are saving less than 5%. I think it's 3.8% of their yearly, right? And the median income is $75K.
Yeah.
I feel that right now.
Right? So, so my point is, right, and I can keep going through the stats, my point is, so we have this flood of inventory. Right? I still don't think we're going to see a crash, right?
No.
But we have this flood of inventory and we don't have enough buyers to take.
Yeah, which I think will help with interest rates coming down. But we just don't know when that's going to happen. I think
And I think this is healthy for our market, right? We haven't really seen a market, we've been in up and to the right since the GFC. I think COVID was kind of an anomaly.
Yeah.
I don't even think I'd really count that.
Well, I don't like even the median prices, which was what I was talking about, I think in a video or whatever last week, in Reno, alone is up 7.8% from last year. So that's crazy. You add Sparks is actually down, but together it's up because Reno takes a lot of that. But even in volume, like it's mind-blowing that people are like, but it's so slow, right? And in theory, it's not. And so
it's coming off of that 2020, 2021 where we didn't have time to even show all the houses we need to show that day.
Yeah.
And you go home and you write 3 offers. Yeah. That was nuts. We're all coming off of that. And if we have a day where we can go golfing, we're like, damn, dude, market's slow.
Yeah.
Even though we're still at like 30 days to contract, which is pretty decent. We're at like 2.5 months inventory if you take Reno and Sparks, maybe a little low, 2.4 or something like that months of inventory. So it is still technically a seller's market.
Yeah, and that's crazy.
And
right?
that's nuts.
We have listings that
and
you're
that's
like,
nuts.
come on.
Even though we have right.
Yeah.
So I mean, as far as the speed of the market, I think we're kind of where we should be, to be completely honest with you.
And then as far as like a lender perspective, so now that rates we've seen a little bit of good
softened
stuff.
A little, yeah.
Now people that are on the fence, have they come back to you and said, hey, is this like, are people getting excited at this softening?
Yeah, and it's always, I mean, it's interesting though, because, you're in it every day, you hear that, the market's down a little bit, where we've maybe gone down 1/8 of a point.
Yeah.
And they're making
you guys are celebrating that stuff.
Well, I mean, and we are, we
Yeah.
are, and the media is, and then the media projects to the consumer, and then the consumer's coming to me and they're saying, I heard rates dropped. And it's like, yeah,
but
they
still
dropped,
sticker
but
shock.
it's, we're still at that, hovering around, we're hovering at around 8 right now, and I think people are so used to hearing other things of like these insane rate drops that when they hear rates have dropped, they're expecting 0.5%, a whole percent. When it's no, the rates are starting to soften and we're starting to see a decline, but we're just starting to see that. Like, we're heading in the right direction, but it's not to a point of where like your purchasing power is going to go up $20,000.
You think it'll stay in that direction? Or do you think we may?
I think we're heading in a good direction.
You just don't know.
There's no crystal ball. It
could get worse again.
It sounds like Powell is calming down.
Yeah, he's pretty dovish right now.
Yeah, which is crazy because he's been very hawkish. Yeah. And so from the indicators we're seeing data. When you guys were talking about the recession, we just saw this big piece of data come through on our group message on Guild, and they're talking about how, how unemployment is up so much, and then there's this chart and it shows how long it took for the economy to go into a recession from that point. And some of it is like -2 months, like they were already in a recession. And so it's like we could already be very much in this recession.
Well, and I think something else to say, right, and I don't want to get super political, and this is broaching that, right? But the term recession has changed over the last 2 years. So many times.
Over the last 6 months, dude.
And so we're...
That's why it's recession.
Right. I don't know if you said this or not in a video or not, Jenna, but I think, right, like, there's a big portion of me inside that's like, maybe this time's different.
Yeah.
Right? Maybe they're going to kick the can down the road a little bit further, or I don't know, right? Like, and I don't want to get too deep into the weeds on that. But I've and Cal gives me flack for this, and a lot of lenders give me flack for this, but I'm a higher for longer guy, meaning, right, I think rates need to be higher for a little bit longer, which I think they're going to be, right? Because the Fed's not talking about cutting rates until March. Things could change. Don't have a crystal ball. We have no idea, right? Do I think they're going to drop a whole point and a quarter? That'd be huge next year. If they,
Huge.
In 3 quarters, because March is into Q1. So you have 3 quarters, right? What can they really do? And I think, like you were talking about, the job owning, right, is where we're going to see a lot of that rate correction over the next 4 or 5 months, right, before the Fed ever actually lowers rates to see what they can do without having to actually do anything.
Yeah.
And so, yeah, like I said, I'm a higher for longer guy because I think that home prices, right, haven't kept up with wages.
Yeah.
And I don't think the solution is just to skyrocket wages because that's gonna create more inflation.
Yeah.
And create higher home prices, which
Yeah.
is the issue that we're in. So I'd like to see some of these home values at least stagnate for a significant amount of time.
Yeah.
Because I have fear for the future
Yeah.
of my kids
Where
being
it's
able
gonna
to
go.
afford a house. Yeah.
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 Well, and I know it's like a 39-year low for housing affordability. And homes are significantly more expensive than they were, and people don't make that difference. It's like 65% higher than the median.
Well,
so that's insane.
I have it right. It's 75K is the median. This is nationwide, right?
Yeah.
I didn't run Reno because I kind of wanted to make sure we covered everything here, but 75K is the median income, and what 75K gets you, right, is between 400 and 425.
And that's
And
even
the
a
median
stretch.
and the median price of homes nationwide is 513,000.
Yeah.
So the median income can't afford a median home.
Well, and that's taking in. I mean, I don't
That's
know what
that's zero debt.
Yeah,
yeah,
That's
and
no
then-
debt. There's
and
no
then-
car payment on that. We
yeah.
add a $600 car payment. Then it's $325 to $350.
And you add in.
And a $600 car
I'm not the
payment
lender,
right
yeah,
now.
I'll let you go.
I don't
Yeah.
know when the last time you went car shopping was.
Yeah,
but
it's at least.
damn,
I
dude.
know. I know.
Yeah.
So I'll just finish real quick, and then you.
Yeah,
and
yeah.
then, so realistically, right, just for the median home price, you have to, with no debt again,
Yeah.
you have to be making $110,000 household income,
Uh-huh.
which is a little scary.
And that's not the average here in Reno.
Yeah.
It's not even close.
So where do I think wages need to go up? For sure. I
Mm-hmm.
think home values need to, not crash, right? Come down and kind of stagnate somewhere
Mm-hmm.
to let stuff kind of catch up.
Yeah, and well, with the data that they were looking at, for raising rates and all of that, is they're looking at our spending, and our spending is not going down, which means that
Yeah.
people are accruing more debt. So you're looking at those figures. That's no debt. People have debt, and people have a lot of it.
And I think it was 2 months ago. So the bow tie economist, I was getting confused with the CCIM, the mid-year economic update that we had at Atlantis. Okay. He was talking about, for the first time in a long time, the number of missed credit card payments is through the roof. And that number is going up and up and up. So people were getting used to this stimulus money during COVID and then started putting more on their credit cards, and now they don't have it and they can't make the payments. And that guy's, he was arguing more along the lines of that and crazy commercial
Right,
loans,
and
that
because
were going to be called. And so that's a terrifying aspect that you could talk for days on.
If unemployment goes up, if we go into recession, right? Why do we go into recession? Because unemployment's up and inflation's coming down, right? Like hypothetically. Right? If unemployment is going up, where is the debt going? It's going to continue to go up.
Yeah. Oh,
So
yeah.
affordability could potentially get even worse from our 39-year
Yeah.
high or low.
Yeah, I know. It's like a hard thing to
Yeah.
say, 39-year low, but it's
Yeah.
high. Yeah. Yeah.
Well, and then there's something that we haven't even touched on is the big players in keeping home prices where they're at, which is the builders.
Yeah.
Because
They're doing the same thing. They're doing concessions to keep, to artificially
Values.
They're doing the same thing we're doing, just
Yeah.
on a bigger scale.
oh yeah.
Yeah.
Yeah. I mean,
Yeah.
we at Guild we have a bunch of builders where we're the preferred lender, and they're doing forward locks. So we're offering a 5.85% on an FHA, and as they're pitching it, they're saying people can afford $50,000 more on a house price. So that means
Effectively, it's
Yeah.
a lower. It's a lower home price. Right?
Yeah.
That's not
Yep.
showing up in the data.
Yeah.
exactly. Yeah, and I mean we even ran into that
Oh, yeah.
on a deal that we did for
Yeah.
that VA loan.
Yes.
They, one of the builders sold something for cash, so they had to lower the price because they couldn't offer a concession.
What does
So
that
when-
do to
So
their-
when the appraisal
and
came in,
then they
it came
expected
in
our
low.
VA
Right.
client to come up with it was
$30,000.
huge.
Yeah,
And
it
we're
was
like, yeah, no,
on a
not
VA,
on
0%
not
down.
on your bad.
Yeah.
Yeah, that was brutal.
Yeah, so it's And a big thing is, you know, a lot of people are operating in fear. And,
Oh, yes.
you know, that's the builders, that's their solution for now.
And they're the telltale, right? So when we start seeing builders actually physically cutting prices, that's when we're going to start to see, you know, they're the leading indicator, I guess is what you would say,
Yeah.
Yeah.
of kind of what's to come.
Do you think they're hurting us by doing that?
Say more.
I can't.
For like the pricing?
Yeah. Do you think they are? Do you think this is like a Band-Aid that they have?
Yes.
And
They're prolonging the bleeding.
right.
Yeah.
Um,
Just like we are.
Just the same thing like we are doing. And at some point it will catch up because
Right.
the appraisers call you. So what was the concession? And so I would say at some point we will start to see appraisals go under again. Just because there's no value there.
I want
just
to
because there's a concession.
I think it's so interesting with what appraisers are up against over the next couple of years.
Yeah.
And I would love to talk about it, but I could spend half an hour on it, and most of it will be yelling. But I just think they have. I just think they have a ton of stuff to worry about coming up.
Because
this is a
it's
huge
also
piece.
going to come into the whole
Commission
Stitcher Burnett
stuff.
stand.
Yes, 100%.
Because people will start adding the
Yeah, I'm already getting
and
fired up.
that's
Did I turn
like
red?
that's value. It's
So I want to add one more stat that maybe we talk about a little bit. So
Okay.
Cal and I were on the phone last night, and I was like, hey, I just saw this stat nationwide. 35% of deals nationwide last month were cash. Right? So that's a third of the market is buying cash. Now, who's buying cash? Yeah, there's some people that are coming in that have made money on a sale and coming in and paying for cash, but I would say a high percentage of those are probably investors, whether they're small or institutional, right? And so potentially, right, and think about this, right? Break this down in your head. I said this to Cal. So what if home values come down and rents go up? Because the affordability. That's kind of a weird scenario to begin. Because it's usually not like that, I would say.
It'd have to be a decent thing for real estate.
Well, yeah, and the thing of it too, though, is that more people qualify for a higher rent than a higher mortgage.
Oh, yeah.
They don't look as in
They don't have
debt.
debt. Yeah, exactly.
Yeah. So they're
'Cause they
like,
don't
oh,
make
you make
debt.
this? Let's go.
Yeah.
So that is interesting to think
That's
about.
really interesting. Okay, now this is going to be a huge wrench in this whole thing if you want to talk about values.
I'm into it.
Okay, so the scariest thing that we're going to be up against is fire insurance.
Yes.
Hands down. And affordability. And this is namely like Tahoe in California, but it's coming. And it's already happening in Incline. So like Mountain Shadows, McLeod, and the HOA is already saying, so if they're changing policies, they're being forced to and getting dropped and getting shifted. And the HOA is already like $700 there. Oh my gosh. They may increase it to over $1,000, it's like $1,100, and make you have a separate $1,000 homeowner's insurance.
Wow.
Whoa.
Per month?
Per month. Right? So then you talk about all these folks that are in there for maybe, I don't know, it's one of the only communities you can short-term rent. They're like, well, I can't make the return I thought. So they're going to want to sell. Then who's going to want to buy? Talk about values going down. And that's terrible in Kingswood off of 267, the Kingswood condominium. Same thing. I get people calling and asking me all the time, like, maybe I'll just exchange. Like, there's no point for us to even keep holding on to it. I haven't had a mortgage in years. Yeah. We're paying in taxes in California, which are ridiculous. And then this? Yeah. So it's a home price they've never even paid before because of fire insurance. Yeah. And that will get worse and worse and worse. And I do think values will come down in Incline because of that. But then it'll be those folks with cash, right? And so then you think about specific areas, which if you don't freaking do a disclaimer on social media, they're like, oh, I'm over here and wherever, and prices are like in the tanks, right? And you're like, okay, well, I'm talking about Reno, Nevada. Incline, what a dichotomy. Yeah. Are people going to come in? Shoot, I'll start an LLC and scoop up Mountain Shadows for $500,000, right? Because that may happen because they can't get rid of them. That's going to be insane. Insane. And that'll happen down here.
We just did a deal on an unwarrantable condo. It's a little similar on a very different scale, right? So unwarrantable, where Fannie and Freddie can't warrant the loan, so you can't do a Fannie and Freddie loan.
Yeah.
right? Because there's litigation on the property, or
Yeah, I was like, you just...
or the pool is broken,
Yeah.
or
Yeah, okay.
which we're dealing with one in downtown Reno. So we did seller financing on that one. But my point is you've got a high-rise building with 1,000 units in it
Yeah.
that nobody can sell because they have to go cash.
Yeah.
Yeah.
And it can be over something as little as
The pool.
yeah.
The pool.
Like
That's like
yeah,
nobody's fault.
The lights
you
in
know,
the
like the
hallways aren't
liability on
working.
that. Yeah.
you know.
Wow. Yeah.
Yeah.
So,
But
so different
yeah.
scale and not fire insurance, but
same.
a problem with the building that they can't,
Yeah.
they're not going to be able to sell them.
Oh, then you add in the HOA stuff
Yeah.
and the people and being able to foreclose on you, so you have no choice but to pay these. And you're like, what?
Yeah, people probably just walk away from the keys at some
At
point.
some point, it wouldn't make sense.
Yeah, if you want to, if you got a growing family in a one-bedroom apartment,
Yeah.
or a one-bedroom studio or whatever, yeah.
And that's just this really sporty side of our industry, but
Yeah.
it's
And yeah, I mean, I guess we probably should have started with the disclaimer, right? We're not economists.
Yeah.
We're not financial
Far from
planners.
No.
We're real estate agents and lenders who love what we do.
Yeah.
And bringing you guys this information to help, right? And to think
Yeah.
about all different scenarios here.
Yeah, and I think it's really important now more than ever to give free value and what we know, and that's how we work every single day because we get the experience, right? And I think our consumers are every day left in the dark and at a detriment of national news. And that's not fair to them, right? But it could be the same outcome. You may not be able to buy a house right now. Totally. That probably, or maybe is not necessarily because of the rates. It could be something completely different, right?
Yeah.
And so it's important that people understand when we try to give value, it's helping those that are seeking solutions and maybe are able to buy, right? Because there's really some good deals to be had right now.
For sure.
But in general, there will always be people that it's not the time to buy.
Mm-hmm. And there's always going to be people that need to sell and buy
Yes.
because of jobs, relocation,
Yeah.
kids, family, empty
Yeah.
nesters. The list goes on and on,
Yeah.
right? And that's the majority. We were talking about this a couple weeks ago, right? So we have restricted inventory.
Mm-hmm.
So I would say right now we have a higher percentage of forced sellers in the market than people that have to sell. So
Yes.
there's more deals out there
Yes.
because of that.
Yep. Yeah. Yeah. I just think this stuff is awesome because educating on our experience and trying to be of more value to people is what's crucial.
And coming
Crucial
together
right
from
now.
different companies and
Yeah.
For sure.
same
And sharing.
same industry.
Come
and,
together.
just
Right
just
now.
talking about
Yeah.
it. It's
Because
cool.
this stuff, the collaboration it will benefit our consumers, our clients, hand over foot every single time.
Yeah.
They'll get a better deal in whatever market that we're in.
Yeah. If it's just me and Ben saying the same stuff to each other over and over and over again, people are
They're like, which one's
"What?"
Ben and which one's Cal?
I was gonna say this is great.
Right?
Yeah.
I love
Yeah.
this.
Even
Okay,
like matching colors.
so like the consensus is you're okay with these rates because you see the value
Yes.
and you
Like
don't,
I said,
but
I'm a
you don't
hire
really
for
think
longer.
it's gonna crash. The market's gonna crash. Yeah, and I think that we're at a really a cool spot in like homeostasis that people are getting a little bit more used to. Like,
Right.
you see a lot of buyers and it's like, ooh, that sucks, but yeah, because
We've
I've
got
been
it.
hearing it.
I just wrote that in the market update yesterday.
Yeah.
Yeah.
I think the biggest thing, right, that we got to look out for, and you guys should be looking out for, is the fear through media,
Yes.
because that is what is going to drive whatever is going on.
Yeah.
Absolutely.
Yeah.
And I mean, piggybacking off of
Fear and greed, right? I mean,
Yeah.
they're going to go hand in hand.
and
Yeah.
the way that knowledge is, you have to come to the source. You have to come to your
Yes.
local people who are in it every single day, because like I know for me, when I was growing up, we lived through that,
Yep.
the whole crash,
Yeah.
and the millennials are the biggest population of age group, and we're coming into the prime age of buying. But after watching all that,
Yeah.
it's scary, and then hearing all of that, it's scary.
Yeah.
So you got to come to people
You gotta come
to
to
talk
people.
about it, because so many people I've talked to that are like, oh, they raised rates today, does that mean my car loan's gonna go up? Does that mean that there's a
I just don't
direct
know.
correlation into the rates? And that's not
Yeah.
how it necessarily works.
The
So
sad
it's
part
like-
is that we get so consumed with our jobs that we think everybody knows.
Right.
And
Yeah.
the common person has no
Yeah.
idea. I forget, I had no idea until I bought a house. I literally did not know how any of this worked. Nothing.
yeah.
Nothing. And I grew
Yeah.
up in real estate. My mom is an agent.
Yeah.
But we
Right.
don't
I
know
was-
until we
right.
know.
I was talking to somebody earlier today, and they were like, with just Fed Chair Powell, right, and not technically lowering rates,
Yeah.
we could go all the way down to 6.5 in a mortgage rate
Yeah.
before they ever even touch rates again.
Yeah.
There's so much more to it
Yeah.
that, you know, I would like to work on simplifying for the consumer, you know? And like when people are like, I don't want to waste your time, I'm like, no, please, like I need to practice talking about
And
this.
let's educate. Yeah. Part of our, like, that should be a huge part of our job, especially going into the Burnett Sitzer thing, right?
For real.
As a buyer's agent, we need to tell them what we do. It's
Right.
not their job to guess. And I think
Right.
that's what got us into this mess,
Big time.
right? Like, we were
time.
not transparent about that, and we do a lot of things, but show your value.
Did that help us pick really bad attorneys? Or I don't know. That's for different.
Crazy.
Hey.
Crazy. But I think it's an opportunity. I truly do think it's an opportunity.
Yeah.
And a lot of agents will elevate to that and rise to the occasion, and some won't, but we see that all the time anyways.
Cut the
Right.
fat.
But take the opportunity to be a better agent.
Yeah.
Nice.
I appreciate everybody.
Thanks.
Yeah.
Yeah. Thanks for coming in.
Nice dynamic duo.
Yeah.